What if I told you that reading a company's balance sheet or listening to a CEO's ambitious growth plans or even, analyzing global economic news might be, well, completely useless?
Yeah, I mean, if you're a purist in the field we're exploring today, you genuinely believe all that fundamental information is just noise.
Exactly. It's just noise. Welcome to this deep dive. Today, we are looking at the National Institute of Securities Markets Research Analyst Workbook, specifically the February 2026 edition, right? And we are zeroing in on Chapter 15.
Which, if you look at the syllabus weightages for the actual certification exam, it's an absolute behemoth. I mean, it carries 15 marks out of 100.
Wow, 15.
Yeah, that is the highest single weightage of any topic in the entire workbook.
Yeah.
It actually beats out valuation principles, financial analysis, all of it.
It just completely dominates the exam. So whether you are, studying to pass that test or you just want to understand how professional traders read stock charts like a second language, this deep dive is basically your ultimate cheat sheet. Okay, let's unpack this. Before we get into candlesticks and momentum oscillators and all the technical jargon, we have to address that massive claim I just made about fundamental analysis being useless.
Right, the elephant in the room.
Yeah. What is the actual dividing line between a fundamental analyst and a technical analyst?
Well, it really comes down to what you believe actually drives the market. Fundamental analysis is the pursuit of intrinsic value.
Like finding out what a company is objectively worth.
Exactly. You are digging through cash flow statements, looking at profit margins, evaluating the management team. But technical analysis operates on a totally different philosophy. The foundational mantra of Chapter 15 is literally price discounts everything.
Meaning every single piece of known information, like from inflation data to political instability, right down to human fear and greed, all of it is already baked into the current stock price the moment it happens.
The very second a piece of news hits the wire.
Yeah.
Thousands of algorithms and institutional traders have already, bought or sold based on it, instantly adjusting the price.
So they don't even bother reading the newspaper.
Right. Therefore, a technical analyst doesn't waste time reading the news because the news is already in the price. They focus strictly on historical price data and trading volume.
Because they think history repeats itself.
Precisely. The core belief is that prices move in recognizable trends, and because human psychology never really changes, the patterns of panic and euphoria we saw a century ago, they're the exact same patterns playing out on our screens today.
But I mean, if price is the only truth, how do we make sense of it? We can't just stare at a flashing ticker tape of red and green numbers all day. We need a framework to identify those trends.
You definitely do. And the absolute bedrock of that framework is Dow Theory.
Dow Theory. This is the Charles Dow stuff, right?
Yeah, Charles Dow laid this out way back between 1900 and 1902. And what's crazy is, even in our modern era of high-frequency AI trading, his core classification of market trends remains the starting point for technical analysis.
That's wild. Over 100 years ago.
Yeah. Dow basically observed that the market doesn't just move in one simple straight line. It has three distinct trends happening simultaneously.
Right. The primary, the secondary, and the tertiary trends. To help visualize how these interact, I always like to think of the ocean.
That's a great way to look at it.
So the primary trend is the macro movement. It's the tide coming in or going out. It's a broad bull or bear market driven by massive underlying economic forces, and it lasts for like a year or more. It is basically unstoppable.
And riding on top of that massive tide, you have the secondary trend.
The wave.
Exactly.
Yeah.
Let's say you were in a massive multi-year bull market, so the tide is coming in. But it doesn't just flood the beach evenly, right? A secondary trend is a temporary decline, maybe a 10 to 20% drop lasting a few weeks to a few months.
So in the ocean analogy, it's the wave crashing against the shore and then pulling back.
Right. It moves powerfully, and sometimes it's even fighting the primary tide for a moment, but it's ultimately just the market digesting its gains before the primary uptrend resumes.
Okay, then you have the tertiary trend, and these are the really short-term, day-to-day fluctuations lasting less than 3 weeks. They are the surface ripples caused by the wind.
The daily noise, yeah.
But I have to push back on this concept a bit. If tertiary trends are just surface ripples, erratic, short-term noise driven by a random daily headline or a sudden earnings beat, why do traders even bother analyzing them?
That's a fair point.
Shouldn't we just focus on the massive, predictable tide?
This raises an important question, actually, and the answer depends entirely on your time frame and your risk tolerance.
Okay, how so?
Well, if you are a long-term investor holding for your retirement, you absolutely ignore the ripples. You want the tide. But for a short-term swing trader, the tertiary trend is literally the heartbeat of the market.
So they thrive on the noise.
They do. Those short-term fluctuations provide the precise timing needed to enter a trade with minimal risk.
Oh, I see. So it's about not getting crushed when the wave pulls back.
Exactly. If you want to ride the secondary wave, the tertiary ripple tells you the exact moment to jump on the surfboard. Yes, these daily movements can be erratic and cause whipsaws.
Whipsaws, like getting chopped up.
Yeah, where you get faked out by a quick move in the wrong direction. But they allow traders to place incredibly tight stop losses. You manage your risk down to the fraction of a percent because you are timing your entry perfectly on that tiny ripple.
That makes a lot of sense. So we know these trends exist on different time frames, but to actually time those entries, we need to see the constant psychological battle between buyers and sellers. We need charts.
We do. And the workbook covers an interesting evolution of charting techniques, starting with the basics.
Right, the line chart, which just connects the closing prices, yeah.
A simple line chart just gives you a clean view of the primary trend, but it completely ignores all the volatility that happened during the trading day.
It's too simple.
Way too simple. So to see that volatility, technical analysts rely on bar charts, often called OHLC for open, high, low, close, and the much more visual candlestick charts.
I love candlestick charts. They use the exact same data as a bar chart, but they draw a physical body between the opening and closing prices, and they color code it. It makes the daily battle just instantly recognizable.
It really does. But before we get into specific candlestick shapes, the text actually introduces these fascinating alternative methods, Renko and Heikin-Ashi charts.
Oh, right. These are cool because they filter out the noise.
They are brilliant tools for filtering out the market's anxiety. Renko charts, for example, abandon the concept of time entirely.
Wait, really? No time access?
No time at all. A new brick is only drawn on the chart when the price moves a predefined amount. If the price just chops around sideways for 3 days without hitting that threshold, the chart doesn't move a single pixel.
That's amazing. It's like putting on noise-canceling headphones in a crowded room. You only hear what actually matters.
That's a perfect analogy.
Mm-hmm.
And Heikin-Ashi does something similar by mathematically averaging out the candlestick data. Both methods filter out those daily tertiary whipsaws so you don't panic and sell your position just because of one volatile afternoon.
But when you do want to see that volatility, when you are looking for the exact moment the psychology of the market flips, you have to take off the noise-canceling headphones and zoom in on traditional candlestick reversal patterns.
Right, because those patterns tell a deeply emotional story.
Let's look at the psychology behind a few of these. Take the hanging man and the hammer. Visually, they are identical, right?
Completely identical on the chart.
They both have this tiny little body at the top of the candle and a long, thin shadow or a tail stretching down below it. And the text says the tail has to be at least twice the length of the body.
Yep, that's the textbook rule.
But despite looking identical, they mean completely different things depending on when they appear.
Because context dictates everything in technical analysis.
Mm-hmm.
So the hanging man appears at the very top of a long price advance. It's a huge bearish warning sign.
The stock has been going up for weeks, right?
Yeah, up for weeks. But on this particular day, sellers suddenly seized control and drove the price aggressively lower. Now, even though the buyers managed to claw their way back and push the price up near the open by the end of the day, the psychological damage is already done.
The bears showed their teeth.
Exactly. The long tail shows that a massive amount of supply is suddenly entering the market. The bull's armor is officially cracked.
What's fascinating here is how the exact same shape tells a story of total triumph when it appears at the bottom of a downtrend.
Right, that's the hammer.
The market has been bleeding for weeks. The day opens and panicked sellers just immediately dump their shares, crushing the price even lower. That forms the long tail.
The final flush out.
Yeah, the final flush. But right at the absolute bottom, the sentiment shifts. Buyers step up, absorb every single share being panic sold, and aggressively push the price all the way back up to close near the high of the day.
The sellers completely exhausted themselves, and the buyers took total control. It's a beautiful thing to see on a chart.
And you see an even more aggressive version of that psychological takeover with engulfing patterns, don't you?
Oh, absolutely. Engulfing patterns are pure dominance. Imagine a stock is trending down. You have a small red candle indicating a normal down day. But the very next day, a massive green candle forms that completely swallows or engulfs the previous day's red body.
It just dwarfs it.
Totally dwarfs it. The bears tried to push it slightly lower at the open, But the bulls responded with overwhelming force, erasing the previous day's losses and then some.
Okay, then you have the three candle patterns, like the morning star and the evening star. They sound like poetry, but they're essentially a highly structured three-act play.
The morning star is a classic bullish reversal. Act 1 is a long red candle showing the bears are dominating.
Everyone is terrified.
Right, that Act 2. The next day opens with a gap down, but the candle body is tiny, a little star. This is the moment of indecision. The selling momentum has suddenly just hit a brick wall.
They ran out of steam.
Exactly. Then Act 3. The final day is a massive green candle that surges violently back up, piercing deep into the price territory of that first red candle. The bears stalled, and the bulls capitalized on the hesitation.
And the evening star is simply the exact opposite, playing out at the top of an uptrend, right?
You got it. It's the bearish version.
Now, these sudden shifts in psychology, these dramatic reversals, they rarely just happen in a random vacuum. They almost always occur at specific, invisible barriers in the market.
Right. We call those barriers support and resistance. They are essentially psychological price levels where the market has a memory.
A memory, like people remember the price.
Yeah. Support is a price floor. It's a level where a downtrend repeatedly pauses or reverses because there's a massive concentration of demand. Buyers see that specific price as a bargain and are just waiting there to pounce.
And resistance is the opposite.
Right. Resistance is a price ceiling. It's where an uptrend hits a wall because there is a concentration of supply. Sellers have decided the price is way too expensive, and they are waiting to unload their shares.
And Chapter 15 emphasizes a critical phenomenon here, which is called role reversal.
Yes, this is huge.
When a support floor is finally shattered by overwhelming selling pressure, it doesn't just vanish into thin air, it flips. That old support floor actually becomes the new resistance ceiling.
It does.
But why does that actually happen? I mean, it sounds like market magic, but there is a brutal mechanical reality behind it, isn't there?
It is driven entirely by the pain of trapped traders.
Okay, paint a picture for us.
Put yourself in this scenario.
Yeah.
You bought a stock at a major support level, let's say exactly at 1,000 rupees. You expect it to bounce, just like it has 3 times before.
Because it's a solid floor.
Right, but it doesn't. A bad earnings report comes out, and it crashes right through that support floor down to 900 rupees. You are now trapped in an incredibly painful losing position.
You're just staring at the red in your portfolio every single day.
Sweating it out. And you are praying for the price to recover. Finally, maybe a month later, the stock rallies back to your original entry point of 1,000 rupees. What is your immediate psychological reaction?
Oh, relief. Absolute relief. I would sell my shares instantly just to get out at break even and end the pain.
Exactly. Now multiply your reaction by thousands of other traders who are trapped at that exact same level. All of those trapped buyers suddenly transform into massive sellers, creating a giant wall of supply right at 1,000 rupees.
Wow. So the old floor mechanically becomes the new ceiling.
Pure human psychology driving supply and demand.
Here's where it gets really interesting, because the market rarely moves in perfectly horizontal lines, does it? Support and resistance are often dynamic, which brings us to trend lines and channels.
Right, diagonal support and resistance.
If a stock is steadily climbing, making higher lows along the way, you can draw a diagonal upward sloping line connecting those lows. That trend line acts as dynamic support. And if you draw a parallel line connecting the peaks above it, you've created an ascending channel. The price is literally bouncing up and down between two parallel diagonal walls as it climbs higher.
It looks like a staircase on the chart. And the standard strategy the workbook outlines is to trade within that channel.
Buy the floor, sell the ceiling.
You buy when the price drops to the lower support trend line, and you take profits when it rallies to the upper resistance line. But, and this is key, you don't do it blindly.
Right, you need confirmation.
Exactly. You wait for the price to hit that lower trend line, and then you look for one of those candlestick reversal patterns we just discussed, like a hammer or a bullish engulfing. That combination is your confirmation.
But eventually, the stock has to break out of that channel, right? It can't just bounce perfectly between two lines forever.
No, eventually the channel breaks.
The text talks about consolidation patterns that happen right before these major breakouts. Things like symmetrical triangles, flags, and pennants.
Think of those as a resting heartbeat. When a stock makes a massive explosive move, it expends a ton of energy. It needs to pause and consolidate.
It has to catch its breath.
Yeah, a pattern like a symmetrical triangle shows the price action getting tighter and tighter, with lower highs and higher lows converging together. The volatility drops dramatically.
It's basically coiling like a spring.
That is the perfect way to describe it. The pressure is building up until it finally violently breaks out, most often continuing the massive trend that preceded the pause.
Okay, let's unpack this. Everything we've discussed so far, drawing diagonal trend lines, spotting a morning star, identifying a flag pattern, it all requires human interpretation.
It is highly subjective, yes.
Right, if you and I look at the exact same chart, you might draw a trend line slightly steeper than I do. We both have human bias. So how do technical analysts strip away that subjectivity?
By applying pure mathematics. That is the entire function of technical indicators.
Ah, the math.
These are complex mathematical formulas applied to historical price and volume data. They plot objectively on your screen, aiming to forecast market direction and momentum without relying on your artistic ability to draw a straight line.
And the workbook highlights a few heavy hitters here, starting with moving averages. But it doesn't just suggest taking a simple, 50-day average. It specifically points to a combination of exponential moving averages, or EMAs, using the periods 13, 21, and 34.
The Fibonacci numbers.
Yeah, those are numbers straight from the Fibonacci sequence. Why on earth are we bringing medieval mathematics and the golden ratio into stock market analysis?
It definitely seems esoteric at first glance. But the Fibonacci sequence mathematically models natural growth and proportional expansion. You see it from the spiral of a snail shell to the branching of trees.
Sure, in nature. But stocks aren't trees.
No, but stocks are driven by people. In technical analysis, it's used because human crowd behavior, those alternating cycles of greed and fear, actually tends to expand and contract in these exact same proportional ratios.
That is why.
And using an exponential moving average instead of a simple one gives more mathematical weight to the most recent trading days, meaning it reacts to sudden price changes much faster.
So how do you actually use a 13, 21, and 34 EMA together on a chart?
They act as a phenomenal, totally objective trend filter. If the current stock price is above the 13 EMA, and the 13 is above the 21, and the 21 is above the 34, and all three lines are fanning out and pointing upwards, there is no debate.
It's just math.
Exactly. You are in a mathematically confirmed, incredibly strong bull market. Furthermore, in that scenario, the 34 EMA acts as a dynamic support floor. Algorithms and institutional traders watch that specific line. When the price dips to touch the 34 EMA, institutional buyers predictably step in to buy the dip.
But moving averages have a fundamental flaw, right? I mean, they are lagging indicators. They only tell you a trend has changed after the price has already dropped significantly.
That is their biggest weakness, yes.
How do traders predict a reversal before it becomes obvious on the price chart?
That is exactly where momentum oscillators come in. Specifically, the MACD, the moving average convergence divergence.
The MACD. The math behind MACD always trips people up. The default setting takes a 26-period EMA and subtracts it from a 12-period EMA. Why does subtracting a slow average from a fast average reveal momentum?
Okay, think of it like analyzing two cars racing down a highway.
Okay, two cars.
The 26-day average is a heavy truck. It represents the long-term trend. The 12-day average is a sports car. It represents short-term price action. By subtracting the truck's speed from the sports car's speed, we aren't just looking at the price anymore, we are actually measuring acceleration.
Oh, that makes sense.
Right. If the sports car is rapidly pulling away from the truck, short-term momentum is accelerating upwards. But if the sports car starts slowing down and the truck starts catching up, the gap between them narrows.
Even if they're both still moving forward.
Exactly.
Yeah.
That tells you the bullish momentum is dying, even if the actual stock price is still technically inching higher on the chart.
That makes total sense. You are measuring the underlying force of the move, not just the surface price. Another massive momentum tool on the text is the RSI, the Relative Strength Index.
A classic.
It's an oscillator that swings on a fixed scale between 0 and 100. And the basic textbook definition says if RSI crosses above 70, the asset is overbought and due for a pullback.
And under 30 is oversold.
Right. But the workbook highlights a much more sophisticated concept here called divergence.
Yes, divergence is where RSI truly acts as an early warning radar for traders. Imagine a stock is in a massive uptrend. It hits 500 rupees, pulls back slightly, and then surges to a new all-time high of 550 rupees.
So on the price chart, everything looks incredibly bullish, higher highs.
Super bullish. But if you look down at your RSI indicator at the bottom of the screen, the RSI value at 550 is actually lower than the RSI value was back when the stock was at 500.
So the indicator and the price are diverging. They're moving in opposite directions.
Exactly. It's like a car coasting up a steep hill. It's still moving forward, reaching a higher altitude, but the engine has completely run out of gas. Bearish divergence tells you that the internal momentum pushing that stock up is exhausted,
The buyers are out of fuel.
completely out of fuel, and a violent reversal is highly probable.
Now, the text also covers the ADX and the OBV. The ADX average directional index is entirely unique because it doesn't even care if the market is going up or down,
Oh,
right?
it doesn't measure direction at all. It
Yeah.
strictly measures the raw strength of the trend. If ADX is under 25, the market is chopping sideways in a tight range. You don't want to use trend-following strategies there. You'll just get chopped to pieces.
But if it's rising above 25,
Then a powerful trend is underway, regardless of whether it's up or down.
and then there's on-balance volume, or OBV. This one is all about tracking the smart money, right?
Yes, because volume is the one thing institutions absolutely cannot hide. OBV is basically a running tally. It takes the total daily trading volume and adds it to the tally on days the price closes higher and subtracts it on days the price closes lower.
Okay, so how do you use that to find the smart money?
Let's say a stock is trapped in a sideways consolidation channel. The price isn't doing anything exciting, just bouncing around. But if the OBV line is steadily marching upward, it reveals a hidden truth.
The volume on the up days is heavier.
Significantly heavier than the volume on the down days. That means large institutional players are quietly accumulating millions of shares, preparing for a massive upward breakout.
Okay, but listen, if we have all these incredible mathematical tools, moving averages acting as dynamic floors, MACD showing momentum shifts, RSI predicting exhaustion, and OBV tracking institutional accumulation, shouldn't trading just be foolproof?
You would think so, wouldn't you?
I mean, how should a listener actually use all these together without getting paralyzed by conflicting signals? Because sometimes the MACD says buy, but the RSI says it's totally overbought.
If we connect this to the bigger picture, the ultimate truth of Chapter 15 is that no single indicator is perfect.
None of them.
None. They all have mathematical blind spots. They all give false signals. The professional secret to technical analysis is confluence.
Confluence. You are stacking the probabilities.
Exactly. You don't just blindly buy a stock because the RSI dipped below 30.
Hmm.
You wait. You wait for the price to drop down into a major multi-year support trend line.
And then you wait for a candlestick.
You wait for a bullish hammer candlestick to form exactly on that trend line. Then you look at your MACD to see if the momentum gap is finally narrowing. And you look at OBV to confirm that heavy institutional volume is backing the reversal.
So you need all the lights to turn green.
When 3 or 4 entirely different technical disciplines all point to the exact same conclusion, you have achieved confluence. You haven't guaranteed a win because there are no guarantees in the market, but you have stacked the statistical probabilities heavily in your favor.
We've covered an immense amount of ground today. We started with the core philosophy that price discounts everything. We mapped out Dow's tides, waves, and ripples. We visualized the raw psychology of buyers and sellers using candlestick reversal pattern.
I covered a lot, yeah.
We mapped the invisible psychological pain of support and resistance barriers. And finally, we used the mathematics of indicators like MACD and RSI to measure the underlying momentum of the market. So what does this all mean?
It means that technical analysis is not a crystal ball. It will never tell you the future with absolute certainty. What Chapter 15 provides is a highly disciplined framework for risk management.
It takes the emotion out of it.
It strips away the emotion of trading entirely. It gives you the structure to define exactly where you will enter a trade, exactly where you will take your profit, and crucially, exactly where you will admit you were wrong and cut your losses.
It's a framework for surviving the market long enough to let those mathematical probabilities play out. And I want to leave you with a final, slightly provocative thought drawn directly from the very end of the workbook chapter. The text notes that critics often argue that technical analysis is simply a self-fulfilling prophecy.
It is a really fascinating philosophical critique to wrestle with.
Think about it the next time you're staring at a stock chart. Does that 34 exponential moving average act as a support floor because of some underlying unshakable law of market physics? Or does the price bounce there simply because millions of traders around the globe and thousands of automated algorithms are all looking at the exact same indicator, waiting to buy at the exact same moment?
That's a great question.
If everyone universally believes the 34 EMA is the floor, they will all place their buy orders there, which structurally ensures that it acts as the floor. As you continue your research and look at your next chart, ask yourself, who is really moving the market? Is it the math or is it the mass belief in the math? Keep diving deep.